Okay, so for this video, we're going to be going through a paper called Does Dividend Policy Foretell Earnings Growth? And it's by Cliff Asness and Robert Arnott. Now, for a little background, Miller and Modigliani back in the 60s wrote a paper about the dividend puzzle, and that is the thought process that investors should be indifferent of whether and to what level companies pay dividends. And this is because if a company pays a dividend, then the investor gets that dividend in his pocket, and he can make an investment decision on his own. Or if the company does not pay a dividend, then the company reinvests that dividend in projects that it sees are worthy of growth, or that should earn the cost of capital or more of the company. And so in that sense, the thought process might be that if a company withholds more of its earnings to reinvest, then the company should experience higher growth of earnings in the future. However, if the company pays out more of its dividends to its shareholders, or more of its cash flow to its shareholders, then future growth should be less. And so in this paper, these guys are going to be exploring that hypothesis and see if dividend policy does foretell earnings growth. All right, so looking at Exhibit 1 here, we have the historical S&P 500 payout ratio. And this is basically the company's dividends divided by their earnings for the preceding 12 months. So what percentage of the company's earnings did they pay out in dividends over time? And we see here that this ratio is somewhat volatile because the dividends tend to be sticky throughout the years, barring some catastrophic event, while the earnings change a lot, so that gives us a very volatile ratio here. We see it at the date of the paper, it's around 2001. The dividend payout ratio was the lowest that it's been in a very long time. And so under the Miller-Modigliani thought process, since the company is retaining more of its earnings within the company for reinvestment, then we should expect higher growth of earnings in the future because they're investing more of the earnings. So in the next exhibit, we'll see if historically that has been the case. So here we have Exhibit 2A, which is the payout ratios versus the subsequent 10-year earnings growth from 1950 to 1991. So we have here the 10-year earnings growth, and down here we have the payout ratio. And so if the M&M Miller-Modigliani theory holds, then we would think that the higher the payout ratio, the lower the earnings growth should be, because you're paying out more of your earnings, so there's less of the earnings held in the company to reinvest for more growth. In fact, what we see here is the opposite of what we would expect. What we see is that the payout ratio is directly and positively related to future 10-year earnings growth. So this is very different than what M&M postulated. If their theory held, we should see a downward sloping data here, where the more the company paid out in earnings, the less the earnings growth should be, but instead we see the opposite. And so to get some more evidence on that relationship of payout ratios to 10-year earnings growth, the authors do a regression here in Exhibit 2B, and the regression equation is that the 10-year earnings growth equals a constant plus the independent variable being the preceding payout ratio. And we see here, again, as we found in the chart before, the coefficient on the payout ratio is positive in all time periods, and also statistically significant, since we have some t-statistics here that are generally above 2. And so we would say that the 10-year earnings growth is positively related to changes in the payout ratio, which is opposite of what Miller and Modigliani postulated. So now to add some more color to that analysis, in Exhibit 3, they've split the payout ratios into quartiles, with the lowest payout ratio and the highest payout ratios, to see what are the subsequent 10-year earnings growth for each of these different quartiles. So we have here the average 10-year earnings growth. Those will be the ones in our charts, the exhibits above. And we have the worst 10-year earnings growth period and the best 10-year earnings growth period for each of these quartiles. We see here in the average column, this obviously increases because that's in line with our figures before. And interestingly, going over to the worst 10-year earnings growth cases, interestingly, we're actually saying here over at the average, the lowest payout ratio quartile has a negative subsequent earnings growth, which is really counterintuitive to what the M&M model would suggest. They would suggest that this lowest payout quartile means companies are keeping more of their earnings to reinvest and should have much higher growth going forward, but instead they have negative growth, which would not be very acceptable to investors holding these securities. And so also in the worst and best cases of 10 years earnings growth, we see a monotonically increasing relationship with the payout ratio. And in fact, the highest quartile payout ratio, its worst 10 years growth period was better than the average for the lowest payout quartile. So what we see here with this chart is that the more companies are paying out of their earnings, the higher the subsequent growth tends to be. So why is it that this counterintuitive result has occurred where payout ratios are positively related to future earnings growth? And the authors have come up with a few potential explanations for why that might happen. The first suggestion is that management prefers not to cut dividends. And so that might mean that the level of the payout ratio indicates management confidence in the stability and growth of the potential earnings, and also that management might keep its payout ratio low if it's not particularly confident in the stability and growth of its future earnings. Going down to the second potential explanation, and this comes from the thought process that management has a number of projects that it can invest its earnings in, and presumably the first dollar of retained earnings will go to the best projects, and with each subsequent project that management invests in, you would get less and less of a return or more risk on those projects. And so the more earnings that the company retains, it invests in marginally less attractive projects. So maybe higher payout ratios means that the company is more efficient and more selective in choosing the projects that it reinvests in, therefore earning a higher return, or rather higher growth. And so the third possible explanation is that maybe sometimes managers retain too much of their earnings in an effort to build empires. And this might build up a significant cash hoard that management might end up spending frivolously. But instead, management had paid out its earnings, management might be more apt to scrutinize its spending, reduce conflicts of interest, and perhaps curtail empire building. So the next, number 4, potential explanation for the positive relationship of payout ratios to future earnings growth might be due to the mechanism of the way that dividends and earnings move. So for instance, dividends are more sticky while earnings are more volatile and generally revert to their mean over time. And so as an example of that, if we think about maybe today earnings are very low and that would result in a high payout ratio. However, if those earnings reverse back to their mean, we would get a high growth rate just from the standpoint that earnings were somewhat depressed at that time because of market fluctuations. And so then we come to the last possible explanation, and this might be that the data or the design of this experiment is wrong and misinterprets the facts. And this could come about if perhaps the time period that we're using is isolated to these results and not specific to the results we would have gotten if we had used different time periods. These results could be due to other fundamentals or variables instead of the dividend payout ratio, and we had used the payout ratio in error. Or maybe more recently there had been more share repurchasing, which would be done in lieu of dividends and give us inaccurate results. And so to test numbers 4 and 5, the authors are going to do some robustness tests in the next section. Alright, for our first robustness check, we go back to Exhibit 2B, and the author alluded to the possibility that when we were looking at the 1950 to 2001 time period, this could possibly be an anomaly. For instance, maybe this time period showed these results, when in fact, over different time periods, this might not come to be. And so the authors did a completely different time period, 1871 to 1949. So this will be an out-of-sample test, and none of these years are included in this one that they did. And they still find a positive relationship between the payout ratio and future 10-year earnings growth. And this R squared is a little bit less than this one, so the variation in earnings growth is not explained completely by this payout ratio variable, or as much as it was with this study. However, we get the same result, the same counterintuitive result, where the payout ratio is positively related to the future earnings growth, even outside of our initial testing and analysis. So this would say that we're not possibly falling into the problem of data mining, and that maybe this occurrence has happened over a very long period of time. And also, if we go back up to the figure here at 2A, if we were to exclude the top and bottom 10% of payout ratios, we would still get this upward sloping results here. So this would mean that the extremes of the payout ratios are not swaying our results, and in fact we have somewhat of a monotonic relationship here. And so for another robustness check, we'll be looking at Exhibit 4A, And this is to test the possibility that maybe the positive relationship of payout ratios to 10 years earning growth is primarily related to the suppression of earnings that are merely reverting back to their mean. So, for instance, if earnings are temporarily depressed, then we would have a larger payout ratio. And then in the future, as the earnings move back to their long-term mean, then it would appear that we had a larger payout ratio initially that resulted in excess growth of earnings, when in fact it was just the volatility of earnings made them be temporarily depressed. So in order to make this analysis, they've added another independent variable here, and that's the lagged 10-year earnings growth. So this would be the 10-year earnings growth over the past 10 years. And the process here would be, or the thought process is that if the positive relationship between payout ratios to 10-year earnings growth is primarily related to a temporary depression in earnings, then we should see a negative relationship between this lagged 10-year earnings growth and the future 10 years earnings growth. So that would tell us that the earnings have declined in the past 10 years, and so then they revert back to the mean in the next 10 years, and that would be a negative relationship here. And so for each of these time periods under study, we do see a negative coefficient here, but the t-statistics are all very small, that is below 2, and so that would say that we don't have much of a basis to say that this coefficient is different from 0. And so maybe that would tell us that the lagged 10-year earnings growth does not significantly explain the future 10 years earnings growth. But in fact, we do still have positive and significant coefficients on this payout ratio. So that might lead us to believe that the significant positive relationship between the payout ratio and 10-year earnings growth is not due to a reversion to the mean of prior earnings. And so as a second test of the potential flaw of earnings reversion to the mean, when we're taking into account the relationship of the payout ratio to the 10-year earnings growth, the authors added another independent variable, and that's the earnings over the 20-year average. And so this is the ratio of the most recent 1-year earnings divided by the 20-year average. So this would tell us whether the recent earnings are high compared to history, or whether the most recent earnings are low compared to the recent 20-year average. And in the same vein as Exhibit 4A that we just discussed, we would expect a negative relationship between this independent variable and the 10-year earnings growth if our analysis was flawed, that earnings revert to the mean, causing this positive relationship between the payout ratio and earnings growth. And that's because the recent earnings would be temporarily depressed compared to the 20-year average. And so thereby, the future earnings growth might be merely caused by a reversion back to that mean rather than the payout ratio being the cause. So as we found before in Exhibit 4A, we also see that there's a negative relationship here, but this relationship is statistically insignificant because we have t-statistics that are less than 2. And we also see that at least with the 1950 and the 1871 to 1941 periods, the payout ratio still has a positive and significant coefficient to show its positive relation to the future 10-year earnings growth. So we might go so far as to say that the prior 20-year returns do not really have a bearing on what will be the next 10-year returns, and that the level of the payout ratio does a better job of predicting the 10-year earnings growth going forward. All right, so next is another robustness test here at Exhibit 5. The authors have decided to look at using the 5-year earnings growth as a dependent variable, whereas in prior tables we had used the 10-year earnings growth. And they've used the 10-year earnings growth previously because the valuation of stocks inherently depends on long-term growth prospects. So, but also the authors have to balance the understanding that the longer time period of this growth they have, the less time periods they have under study. So here they've reduced the 10-year earnings growth to 5 years, and this sacrifices a little bit of long-term focus, but gives us more individual time periods over the time period under study. And so in doing so, they still find that the 5-year earnings growth is directly and positively related to the payout ratio. And we have some statistically significant t-statistics here, as well as we still have pretty high r-squareds. And going down, they've also changed the time period to end at 1979, but also to go after 1979, and we see the same result where we have significantly statistically positive relationship between the payout ratio and 5-year earnings growth rate when halting the time period at 1979. And the reason that they decided to halt at 1979 is because share buybacks started to become more prevalent after 1979. So if share buybacks are a substitute for dividends, then the payout ratio used in this study is significantly depressed compared to what it should be if we had added in the share buybacks. And so in order to mitigate this risk, the authors halted the time period at 1979 to only show the periods characterized by normal dividend payouts before the post-1979 period when companies started doing more share buybacks. And in addition, more share buybacks should increase the earnings per share as less shares are in circulation. And so all of that should weaken the results because lower payout ratios, if they are being substituted by dividends, and then also increases in earnings per share, would mean that these lower payout ratios should result in higher future earnings growth. But we see here that didn't happen. And in fact, we see that the period where there were more share buybacks, our equation actually became stronger than the pre-period of share buybacks with a 50% R squared, a higher coefficient. And so next here at Exhibit 6A, the authors want to understand how consistently does this particular regression explain the variation in returns of 5-year earnings growth. So this time we're using the 5-year earnings growth, and we've got the same regression where we have the payout ratio as the independent variable to see how well it explains the future 5-year earnings growth. And so the authors did this regression over 30-year rolling periods from 1871 forward. And so the first period ends at 1902. And this side over here is the R squareds of this regression. So the R squared would tell us how well does this regression explain the variation in earnings growth over each of these 30-year rolling periods. And we see it's a very variable R squared. So in this period, the regression did a very good job of explaining the variation in earnings growth. And this period explained it a bit less well, but in all cases we do have a respectable R squared, and in all cases the payout ratio is positively related to the earnings growth. So the higher the payout ratio, the higher the earnings growth for the next 5 years, and vice versa. And going down a bit farther, we have Exhibit 6B, which does the same regression, only this time we have the t-statistic over here. So t-statistics above 2 would generally signal that we might can conclude this coefficient B here we could be safe to say that it's likely not zero. So in that case, the payout ratio would have a positive and significant relationship with the earnings growth. And so see here over this entire span from 1902 to 2001, there's only been a few times where this t-statistic approached or breached below 2 possibly. So we can conclude that the payout ratio is a good predictor of what the future 5-year earnings growth rate might be. So next in Exhibit 7, authors are performing the same regression, only this time the independent variable is the yield curve slope. So this would be the ratio of long-term interest rates to short-term interest rates. And historically, higher yield curve slopes have predicted higher earnings growth going forward. And so authors are wondering, well, does the payout ratio that we've been looking at previously work in the same way that the yield curve slope worked? Or rather, does this yield curve slope simply subsume the validity of the payout ratio? And this might happen during periods of recession, like we've seen where the payout ratio is very high, because earnings are temporarily depressed while the dividends are more sticky, resulting in a higher payout ratio. And does that stem also from the yield curve slope operating in the same way, where it's usually higher during recessionary periods? So both of those situations might predict an economic and an earnings rebound. So they've done this on both the 10-year and the 5-year earnings growth. Let's look at the 10-year. We see here that in all cases, the yield curve slope is positively related to the future 10-year earnings growth. And this is overall time periods. Although this has a very small t-statistic, and also the R squared is very small, actually much smaller in all cases than what we saw with the regression of the payout ratio. So let's see what happened in the 10-year earnings growth. We have a much better result here, much higher coefficient, much higher t-statistics, and so this may confirm the validity of the yield curve slope to predict future 5-year earnings growth rates. However, let's go down to panel B of this exhibit, and in this case we have a regression that includes both the yield curve slope and the payout ratio as the independent variables. So with this we will find whether one subsumes the other, or when we control for the other, does one come out as being the better predictor of the earnings growth rate for both 10-year and 5-year earnings growth. So looking at the 10-year earnings growth, we first see that the yield curve coefficient is small, and both also statistically insignificant because the t-statistics are a bit less than 2, except in this case. But what we do find is the payout ratio coefficient is significantly positive. We have pretty large t-statistics here. And so what we found is, at least with the 10-year earnings growth, the payout ratio does a much better job of predicting the 10-year earnings growth than does the yield curve slope. So let's go down to the 5-year earnings growth. We see in this case the yield curve slope has some significance here, but so also does the payout ratio. Therefore, what we found is the yield curve slope is very insignificant compared to the forecasting power of the payout ratio. And in fact, when they're combined together, the yield curve slope doesn't take away the efficacy of the payout ratio in predicting these future earnings growth. So next here in Exhibit 8, the authors want to compare the ability of earnings yield for predicting 10-year earnings growth versus how valid is the payout ratio to predicting 10-year earnings growth. So the thought is that an investor should be willing to pay more for a company if it has higher expected earnings growth in the future. So that would result in a smaller earnings yield here, which is the inverse of the PE ratio. Therefore, if the thought holds that earnings yield is inversely related to future 10-year earnings growth, then this coefficient should be 0, or it should be negative. And that's what we do find here, is that the higher the earnings yield, the lower the 10-year earnings growth, and vice versa. And that comes with a very significant t-statistic here, it's about 2. So indeed, we do find that stocks that are purchased at a lower earnings yield should have higher 10-year earnings growth over these time periods. So let's go down to panel B, where we're adding in the payout ratio as an independent variable. And we see here, at least with these first 2 time periods, the payout ratio has wholly subsumed the power of the earnings yield. Actually, in all cases, where we have much higher t-statistics for the payout ratio, and the t-statistics of the earnings yield are much lower than they were before. So we see that the payout ratio has been a much better predictor of the earnings growth than was the earnings yield purchased at. So this analysis might help us in resolving conflicts between investor perceptions and management perceptions. For example, in a situation where PE ratios are very high because the market expects particularly high earnings growth in the future, but that's coupled with low payout ratios, which of these should an investor believe? And we see here that it's more prudent for an investor to look at the payout ratio as being the indicator of future growth, because maybe management has better insight as far as whether this growth will really happen or not, and maybe that's reflected in his dividend policy. By paying less dividends now, he is anticipating and protecting for lower growth in the future, whereas the investor may be misinformed by paying more for the company in anticipation of growth. So in summary, this leads us to believe we should pay more attention to management through their dividend policy than to the market through their valuation calculation and decisions.